Hi, today we are going to study hedging with futures. All this while we have studied what is future. So now how to do hedging with futures. Hedging is one of the most important and practical applications of futures. And what is hedging? Let us try to understand through common sense approach. We all know when a child is born and doctor will give vaccination to the baby, and nowadays vaccination spans over a period of 1 year or 2 years, in some case more than that. So why vaccination is required? Because in human body both good bacteria and bad bacteria are there. There are some bacteria which are good for immunity of the human body and which helps. There are some bacteria which impacts adversely the immunity system. So now if we have medicines at one go, antibiotics, which will kill all bacteria, and that is not the intent. So we want to preserve good one and we want to address the issue which is being caused by bad bacteria. So we need to address that part only. So that is why we need to give additional injections to the babies even when they are not getting disease. It is just a small workaround in order to prevent bigger risk which might cost due to presence of bad bacteria. And now since good and bad are staying together, I cannot segregate. So then I have to take a separate action to address the issue. So here that vaccination, we can say that we are hedging against the risk of getting disease very soon because of weak immunity. Yeah. Let us think another example. Suppose I want to grow spinach in my garden. Yeah. So when I grow the spinach, it's very leafy, those trees become, and then on the field that cows and goats, they are grazing, lambs, they come and they eat those leaves. So because that risk of those harvest being eaten up by these animals, does that mean that I cannot grow in my field anything? So in this case, what I need to do? I have to take a position so that I can grow, and at the same time the risk of this harvest getting devastated by these domestic animals should not be there. So what I can do? Simply I can put a fence around that. So if I put that fence, then those animals won't be able to come inside. So those spinach and whatever I have grown in the field, those would be intact. So fencing is, in this example, is another kind of hedging which is preventing me from that risk. What is that risk? Risk of being eaten up. Those animals should not harm these trees. Yeah? Should not harm this harvest, what I am growing. Let us come back to financial world. So in market movements can be adverse. Hedging is just a simple workaround, an additional workaround to protect our trading positions from making a loss. So in my example, the way vaccination and the fencing is protecting against the unavoidable risk. Similarly, when there is an adverse market movement, then this hedging helps us to protect us. What is to protect? Risk of incurring loss. Yeah. Suppose I have invested in one stock which is 100 rupees and I feel the market is going to go down. Whatever be the reason, it will be in the declining trend. So there could be three things which I can do. Because of this, my anticipation, I can think, okay, I am anticipating that this will go down, but no need to take any action. Let the stock go down. Anyway, it will eventually bounce back. Whatever goes down will come back, right? Will move up. So I can take no action depending on this age-old philosophy. Second, what I can take action? I can sell the stock because I am anticipating market will go down. So sell the stock and then wait till it is coming at a lower price and then buy it back. That also can be done. And the third is hedge the position. So what will happen if I do the first two actions? Let's understand one thing. Suppose I have invested 100 rupees and imagine because market has formed a bearish pattern and it has gone down to 75. Yeah. Now from 100 rupees to rupees 75, it's a 25% drop. Market has gone down for that stock 25%. Now I am expecting that anyway it will move up. Now in order to move up to again coming back to 100 rupees, how much it has to traverse? 25 rupees on 75. So that means market has to move up 33% approximately to reach to my original investment value. Yeah. So now normally when market has gone down by 25%, normally it will not happen that 33% it will go up very soon. Even if there is a raging bull market exists, but then the stock has gone down, right? Even raging bull market comes, it may happen if some rigging or some speculation happens, but in a normal balance, if the stock goes down 25% and moving up 33% in near future, unlikely. Yeah. So that means when I am anticipating a massive adverse movement in the market, then it is better to hedge the position instead of taking no action and just waiting when the market will bounce back on its own. Yeah. Now what about the second option? Second option that I can sell the stock and then after selling I will definitely hope, that is human psychology, that stock should fall further so that I can buy it back. So what will happen in this case? First of all, I am then timing the market. And any experienced trader or investors, market took them to task when they wanted to time the market. It is next to impossible thing. Yeah. And moreover, the more number we are transacting based on what? Based on our anticipation. Anticipation may not reality actually, But the more number you are transacting, we cannot leverage long-term capital gain tax. We have to pay short-term capital gain tax, and moreover, the brokerage portal, wherever we are effecting these transactions, definitely they will charge every time transactional fees. Yeah. then what else? What we can do which will save me for getting unnecessary exposure of risk? Then there is only one option remains, that is hedging. Hedging is virtually I want to insulate my position from the market movement. Yeah. So when a trader hedges, he can be rest assured that the adverse movement in the market will not affect his position. Yeah. Now, before explaining further how we can position ourselves so that market movement will not affect us, one basic things let's try to understand. Actually, what we are hedging? We are hedging the risk. Yeah. In financial management, the three aspects drives the whole world of finance. First is risk, second return, third liquidity. So risk being risky, risk means unexpected outcome. Yeah. So this is the risk we need to address in priority, and that is why we are hedging the risk factor. Yeah. Now there are two types of risk: systematic risk and unsystematic risk. What are these? Suppose I have bought a stock of any company. That stock can go down for various reasons. The reasons could be the company's revenue is on declining trend, profit is not there, or it has incurred huge loss, huge financial cost. Nowadays, a lot of bank has NPA, non-performing asset, because of that higher financing cost. Company is highly debt stressed, highly leveraged company. Management is not conducting in a very true and fair manner. Or the company may be doing good, but the demand-supply equation is changing. So that will impact the revenue or the growth prospect of the company. Yeah. There could be other reasons also. So these are the various reasons which represent a risk. Yeah. Which represent risk, and due to these risks, stock price can decline. Yeah. But these are company specific risk. Imagine, suppose you have bought a Infosys stock and you have bought the stock at rupees 3,000. And in AGM, Infosys CEO is declining that the growth estimate, he revised the growth estimate 1.5% below than previous estimate. It happens, no? And moreover, nowadays ITES industries are facing a lot of headwinds. Yeah. So what will happen in the market? The moment he will revise the growth estimate and reduce the growth target slightly below, market will react, stock price will fall. Now the stock price will fall for the Infosys stock. SBI stock, if you buy, SBI stock will not impact because of his announcement or his view in that industry. So this means these are the risks which are specific to the company itself, or in other words, company specific risk. Company specific risk is called unsystematic risk. Yeah. So when the type of risks which are specific to the company and affect only the company in question and not others. Yeah. When Satyam management, they did lot of misconduct. They rigged lot of financial statements, and when it came out in the public, Satyam stock plummeted big time. But Satyam stock, because of management misconduct, impacted. Not TCS stock, not Infosys stock that time impacted. So this type of risk called unsystematic risk. Because it is not related to the system or economy. It is related to the particular company in question. Yeah. Unsystematic risk. So how to manage unsystematic risk? We can minimize unsystematic risk through diversification. Yeah, imagine I have 1 lakh rupees. Instead of putting all my 1 lakh rupees in Infosys stock, I can buy 3 stocks, say Infosys, State Bank, and Coal India. All three are from different industry. So if Infosys stocks down and I put say 33,000 in all stocks, assume equally I am investing in all 3 stocks. So if Infosys stocks going down 10%, my 1/3 of investable capital, that 1 lakh would be impacted. Not 2/3 will not be impacted, right? So higher number of the stocks in my portfolio, higher diversification, and we can minimize the unsystematic risk, because all company will not face challenges at one time and one time all will go down or go up. It cannot happen like that. Yeah. However, just to share over here, too much diversification also might create a problem. If we diversify that capital 1 lakh more than 50 stocks, that will not work again. Normally it is said 20 to 25 stocks diversification is good. So this we will study when we will study in portfolio management. Yeah. So unsystematic risk, another name is called diversifiable risk, because this type of risk can be minimized through diversification. Now the question is, whether diversification can address all type of risk, or is there any risk that can remain even after diversification? Yes. Again, one type of risk remains, and that is called systematic risk. Systematic risk is like when there is a GDP growth going down, interest rate, higher interest rate. As you know that market always moves the day RBI governor shares their policy stance, right? Inflation, data when come out, fiscal deficit, and geopolitical risk. We have umpteen number of geopolitical risk nowadays we are going through. So these are the risks. These are not company specific. This sort of risk affects all stocks. So imagine I have a well diversified portfolio where I have banking stock, FMCG stock, ITS company stock, pharma stock, yeah, infrastructure stock. But if inflation goes up, it will impact all stocks. May not be in the same percentage, but it will impact. Yeah. Why it will impact? Because these are the risks related to the bigger system, economy. And this risk inherent in the system. So diversification will not help. When diversification will not help, then hedging only will come to rescue in terms of minimizing systematic risk. Yeah. So, one thing we need to be very clear. Hedging and diversification are two very different things. We diversify to minimize unsystematic risk. We hedge to minimize systematic risk. Clear? Now what is hedging? Suppose you have bought 250 shares of Infosys at rupees 2284 per share. So total investment, you have invested money, say 5,71,000. Yeah. So you have bought shares in cash market and you are holding those shares. So that means you are long on Infosys in the cash market. Meaning you are buying and you will sell later. So your position is long in the spot market. Cash market, spot market, same thing. Yeah. Now, after buying these shares, then you realize that quarterly result, and as I shared that example earlier, that you are sensing that Infosys management may announce some numbers which may not be very favorable, or they will announce something, some sticky issues they will address, which market might not take it very well. It will not go down well in the market sentiment. So definitely then stock price will decline. So then to avoid making that loss in the spot market, you can hedge the position. Now how? Now one thing we need to understand, it is your anticipation that market will go down, and that is why it might come out true. So that is why for that we need to hedge the position. So now hedging means taking a position which will address the risk of making loss in spot market. So definitely I have bought shares in spot market and I have to enter into a counter position in the future market. Then only I can mitigate the risk or minimize the risk. So cash market position is long. I have to take short position in future market. Yeah. And let's say in short future exchange is quoting 2285 rupees per share. And lot size for this share is 250. So for one lot, my contract value would be 5,71,250 rupees. Yeah. So now see what is the situation. On one hand, you have taken a position long on Infosys in the spot market. And on the other hand, we are short on Infosys in future market. Though a little bit different price, definitely price would be different. But we have taken a short on Infosys in future market. So what will happen here now? The variance in price now is not a concern. You no need to worry what the management will come out. Even if they will come out with very set of numbers or some announcement which market is not taking it favorably and price will go down, but your position directionally neutral. You are long in spot market, short in future market. How it happens? Imagine the day when future expiry is there, that day price is 2,200. So if spot market price 2,200, my loss, nominal loss, because I have bought at 2284. So my loss is 2200 minus 2284, which is 84 rupees loss. This loss on long spot. But now I have to sell the future, and I am selling future at 2285 rupees, whereas cash market quoting 2200. So I am making profit 85. So loss 84, profit 85. So net gain 1 rupee. Similarly, say another arbitrary price, say 2290. Then my profit would be there in spot market, because market is quoting 2290. I bought share 2284. So my nominal gain is 6 rupees. And what is future? Future, I am short at 2285. Market quoting 2290. So loss minus 5. Plus 6 long spot, minus 5 short future. So net gain 1 rupee. Another price you take, say 2500. 2500, market is quoting, spot market, and I bought share at 2284. So my profit, long spot, 216. And what is the situation at short future? I have to sell at 2285. And market is quoting then to 2500. So loss is minus 215. So long spot 216 plus short future 215 minus net gain 1 rupee. So what does it mean? It means because I have taken a long position on Infosys stock and I am doing short on futures, so directionally I am taking a neutral position. Yeah, because my position is frozen. See, the risk is either market can go up or go down, and I am covering both sides, which means directionally, whatever be the price movement, my position is neutral, or my position is a frozen state. So it will not gain or loss, but it will minimize the risk, and that is all about hedging. So this is a single stock position hedging. Now what can happen? Suppose I have an exposure in a stock which has no future in the exchange. So then can't I cover my risk? Or it may so happen that I have taken exposure, but that exposure is lesser than the lot size which is quoting in the exchange. So in that case, if I do hedge, it would be imperfect hedge, yeah? Or it may so happen that I have portfolio of stocks. So then how to hedge? So these are the instances which are not very straightforward. So that we will discuss in my next video lessons. Until then, thank you.